Silver just did something that hasn't happened in years. Prices didn't fall. They collapsed. Billions wiped out in minutes. Every trader watching this went silent. And the ones who saw it coming, they already know what happens next. But here's the part that nobody is talking about. The real reason behind this crash is not what you think. And if you hold precious metals, if you're building wealth, if you care about where your money actually stands today, then what I'm about to reveal could change the way you look at the market forever. Now welcome to Silver Radar, the one place where markets don't just get reported, they get dissected. Now, before we go any further, you know the way a wise elder passes down knowledge to the next generation? That's exactly what we do here. So if this channel has ever made you think, ever made you pause, ever made you say, wait, I didn't know that, then do an old man a favor, hit that subscribe button. Not for us, for yourself. Now tell us in the comments, where in the world are you watching this from today? The clock struck midnight in New York City, but in the world of global markets, midnight means nothing. Trading never stops. Not really. And somewhere, in the quiet hours before most people even woke up, silver started falling. Not slowly, not gently. It fell the way a building collapses when the foundation cracks. Fast, sudden, and completely without warning. Traders in Tokyo were the first to notice. Their screens flickered, numbers turned red. One trader stared at his monitor and simply said nothing, because sometimes the numbers speak louder than any reaction ever could. Within the first hour, silver had already dropped several dollars per ounce. For casual observers, that number might sound small, but for anyone who actually holds silver, who has real money sitting in precious metals, that small number represented millions. London markets opened next, and the mood was not uncertainty. It was silence. The kind of silence that fills a room when everyone already knows the answer, but nobody wants to say it out loud. By the time New York traders arrived at their desks, the damage report was already written. Silver had entered what professionals call an air pocket. No buyers, no resistance, just a straight vertical drop into empty space. Now, to truly understand what happened that morning, we need to step back just slightly and look at where silver was before this crash unfolded. For weeks, silver had been climbing, every day a little higher. Investors were watching with growing confidence. The narrative was simple. Precious metals are safe. The rally will continue. Silver is heading higher. And people believed it. But here is what most retail investors never understand about markets. Confidence is not a foundation. It is fuel. And when confidence burns too hot, too fast, too blindly, the crash that follows is not just possible. It becomes inevitable. So while the public was celebrating, while social media was filled with predictions of new highs, something else was happening quietly behind closed doors. Institutional traders, the ones who move real money, were already repositioning, silently, strategically, without any announcement, and then the trigger was pulled, not by one trader, not by one country, but by a combination of forces that had been building like pressure inside a sealed container, and on that Sunday morning the container finally cracked. Silver didn't just fall, it got slammed. The speed of the decline was so aggressive, so sudden, that it shocked even veterans who had seen crashes before, because this was not a normal correction. This was a violent repricing of everything the market thought it knew about precious metals. And silver was not alone in this fall. Gold, the most trusted asset in the history of wealth, also came under pressure. But the difference between how gold moved and how silver moved, that difference tells us everything we need to know about what truly happened. Gold dipped, silver collapsed. And this is not coincidence. This is not random. This is a pattern that has repeated itself dozens of times throughout market history. A pattern that every serious businessman and wealth builder must understand. The reason is simple, but powerful. Silver is a thinner market than gold. Less money flows through it, less liquidity exists inside it, and when a market is thin, every move gets amplified. Like shouting into an empty canyon, the echo is always louder than the original voice. So when selling pressure hit, silver didn't just absorb it, it multiplied it. Every seller pushed the price lower, which triggered more sellers, which pushed it even lower. A chain reaction that fed itself until the damage was done. Now, one of the most important indicators that traders and analysts immediately turned to was the gold to silver ratio. This ratio is simple to understand. It tells you how many ounces of silver it takes to buy 1 ounce of gold. And on this particular day, that ratio moved back above 60 to 1. What does that mean in practical terms? It means silver became significantly cheaper relative to gold. And historically, when this ratio stretches to these levels, it does not stay there forever. But whether it corrects quickly or whether it stretches even further before finding balance, that is a question the market had not yet answered. So here is where we stand at the end of this first chapter. Silver crashed. Gold held relatively stronger. The ratio expanded. Billions in value disappeared within hours. And the entire market was left asking the same 2 questions. Is the rally truly over? Or is this crash just the beginning of something else entirely? Everyone wanted a villain. When silver crashed that hard, That fast, the first instinct of most people watching was to point fingers. The market is rigged. The big players manipulated the price. Someone is stealing from the little guy. And honestly, that reaction is completely understandable. When you watch your wealth shrink in real time, anger feels natural. It feels justified. But here is the uncomfortable truth that most people never want to hear. The market did not need a villain that day. It needed a mirror, because everything that happened was built into the system long before the first candle turned red. The crash was not an attack. It was a consequence. And understanding that consequence is the difference between someone who survives market volatility and someone who keeps getting destroyed by it. So let us start from the very beginning. Not the beginning of the crash itself, but the beginning of the conditions that made the crash possible. Because markets do not move in isolation. They move because of pressure, and pressure always builds before it releases. The weeks leading up to this event were not ordinary. Silver had been rising steadily, and with every rise, more money entered the market. More traders opened positions. More leverage was deployed. And here is the critical detail that most retail investors completely ignore. A significant portion of that money was borrowed money, not real capital sitting safely in someone's account. Borrowed, leveraged, placed into the market with the assumption that prices would keep climbing. And as long as prices did climb, nobody questioned it. The system worked. Everyone was happy. But leverage is not a tool that rewards confidence. It is a tool that punishes overconfidence. And the market had become extremely overconfident. Now, when prices started to slip, something mechanical kicked into motion, something that has nothing to do with sentiment or headlines or global politics. It is called a margin call. And if you have never experienced one, consider yourself fortunate. A margin call is an automated notification sent by a brokerage to a trader. It says one thing very clearly. Your position has lost enough value that the borrowed money is no longer covered. You must deposit more funds immediately, or your position will be closed automatically. Not tomorrow, not next week, immediately. And here is what makes margin calls so dangerous in a market like silver. They do not happen one at a time. They happen simultaneously. Dozens, then hundreds, then thousands of traders across the globe receiving the same alarm at the same moment. And when all of them are forced to sell at the same time, the selling pressure becomes overwhelming. It is not one person dumping silver. It is an avalanche, a mechanical, automated, unstoppable avalanche of forced liquidation that pushes prices lower, which then triggers even more margin calls, which forces even more selling. It is a cycle, and once it starts, it is nearly impossible to stop until the damage reaches a natural resting point. This is why silver fell so much harder than gold during this event. Gold is a deeper market. More money flows through it. More liquidity exists at every price level. So when selling pressure hits gold, there are enough buyers at various levels to slow the decline down, to create resistance, to prevent a free fall. Silver does not have that luxury. The silver market is significantly thinner. And in a thin market, when forced selling begins, there is simply not enough buying interest to absorb the pressure. The price does not decline gradually. It gaps lower. It moves in violent, sudden drops that skip over entire price levels without a single trade occurring in between. That is the air pocket. That is the cliff edge that traders saw on their charts that morning. But the margin calls were only one piece of this mechanical puzzle. The second piece involves something called positioning. Before the crash, large institutional players, hedge funds, banks, and commodity traders had built significant positions in precious metals. Some of these positions were long, meaning they were betting prices would rise, but others were short, meaning they were betting prices would fall. And the balance of these positions, the ratio of longs to shorts, had become extremely stretched in one direction. Too many players were betting on the upside. And when a market becomes that one-sided, it becomes fragile. One negative trigger, one unexpected piece of data, one shift in macro sentiment, and the entire structure collapses inward on itself, like a tower built too high on a foundation too narrow. The dollar also played a role that day. When the US dollar strengthens, precious metals typically face headwinds. A stronger dollar means that gold and silver, which are priced in dollars globally, become more expensive for international buyers. This reduces demand. And reduced demand, combined with the forced selling already underway, created a perfect storm of downward pressure that silver simply could not withstand. So when people asked that day, was this manipulation? The honest answer is no. This was not a conspiracy. This was not a hidden hand moving prices in the shadows. This was a system functioning exactly as it was designed to function. A system that rewards discipline and punishes excess. A system that amplifies fear when fear is already present. And a system that will always, without exception, deliver this exact outcome when the conditions are right. The crash was not surprising to those who understood the mechanics. It was inevitable. The only question was never whether it would happen. The only question was when. And now that it has happened, the real conversation begins. Not about what went wrong, but about what the data and history actually suggest happens next. And that is exactly where part 3 takes us. History does not repeat itself exactly, but it rhymes. And if you have spent enough time studying markets, truly studying them, not just scrolling through charts and listening to predictions, you start to hear the rhyme before most people even realize a pattern is forming. That is exactly what is happening right now. Because this crash, this sudden and violent repricing of silver, did not arrive without a historical twin. It arrived with a family, a long line of predecessors that behaved in remarkably similar ways. And every single one of them left behind a trail of data that tells us something important about what comes next. But here is what makes this moment different from simply looking at past crashes and drawing conclusions. The data does not point in one direction, it points in two, and the direction that actually materializes will depend entirely on which set of conditions the current market most closely resembles. So let us walk through both. Because any serious analysis that only presents one side of the equation is not analysis at all, it is storytelling. And this is not a story, this is a briefing. The first historical parallel worth examining happened during a period when silver experienced a sharp correction after an extended rally, not a gradual slowdown, a sudden aggressive drop that caught the majority of the market off guard. Sound familiar? During that event, the gold to silver ratio expanded significantly, moving well above 60 to 1. Investors panicked. Headlines declared the end of the precious metals bull market. And within 6 weeks, silver had recovered more than half of its losses. Not because of luck, not because of government intervention, but because the very conditions that caused the crash also created the conditions for the recovery. The forced selling pushed prices to levels where genuine buyers, the ones with real capital and long-term conviction, found value they could not ignore. And they stepped in. But that is only half the picture. The second parallel is less comfortable. And it is the one that most analysts prefer to skip over because it does not fit a clean narrative. There have been instances in market history where silver crashed just as violently, where the ratio stretched just as far, and where the recovery did not come in weeks. It came in months, sometimes longer. During these periods, the initial crash was not the bottom. It was simply the first leg down, and the market continued to grind lower, slowly and painfully, before eventually finding its true floor. The difference between these two outcomes was not random. It was structural. It depended on the broader economic environment at the time, on interest rates, on inflation expectations, on whether the global economy was expanding or contracting, on whether institutions were accumulating or distributing. These factors did not determine whether silver would recover. It always did eventually. But they determined how long that recovery would take and how much additional pain would be endured before it arrived. So which parallel does the current situation most closely resemble? That is the question every serious market participant is wrestling with right now. And the answer requires us to look beyond silver itself and examine the macro environment surrounding it. Interest rates remain a critical variable. When central banks maintain high rates or signal that rates will stay elevated for longer, precious metals face a structural headwind. Higher rates make yield-bearing assets more attractive relative to gold and silver, which produce no income. They simply sit there and hold value, or in moments like this, lose it. If the current rate environment remains tight, the recovery in silver could be slower and more painful than the first historical parallel would suggest. But if rate expectations shift, if the market begins pricing in cuts or easing, the dynamic changes entirely. Silver, being more volatile and more sensitive to economic shifts, would likely respond faster and more aggressively than gold. That is its nature. It amplifies moves in both directions. Inflation expectations add another layer to this analysis. Silver has historically performed well during periods of rising inflation, or when markets anticipate inflation to rise. If the current economic data continues to suggest persistent inflation, that creates a tailwind for precious metals over the medium term. Not necessarily tomorrow, not necessarily next week, but over the horizon that matters most to wealth builders and serious investors, the months and quarters ahead. The gold to silver ratio itself provides one final piece of evidence worth examining closely. Throughout modern market history, every time this ratio has expanded above 80 to 1, silver has eventually outperformed gold in the recovery phase. The ratio has contracted back toward historical norms each time, without exception. The current ratio, while elevated and stretched, has not yet reached that extreme threshold, which means it sits in an interesting middle ground, stretched enough to signal opportunity, but not stretched enough to guarantee a rapid correction back to balance. It exists in a zone of uncertainty, and uncertainty, in markets, is where the greatest rewards and the greatest risks coexist. There is one more historical observation that deserves attention before this section closes. The behavior of retail versus institutional investors during recoveries from sharp corrections like this one follows a very predictable pattern. Retail investors, The majority of individual traders tend to exit the market after a crash like this. They sell their positions. They step away. They decide that precious metals are too risky, too volatile, too unpredictable to be worth the stress. And institutional investors, the ones with deep pockets and longer time horizons, quietly begin accumulating at the very prices that retail investors are abandoning. This is not speculation. This is a documented pattern that has repeated itself consistently across multiple market cycles. The people who build wealth through markets are rarely the ones who react to crashes with fear. They are the ones who understand what a crash actually represents. Not an ending, but a repricing. A moment where assets move from weaker hands into stronger ones. And the strongest hands are not the ones holding the most money. They are the ones holding the clearest understanding of what the data actually says. The data right now does not tell us silver has ended its journey upward. It tells us silver has paused, violently, painfully, but paused nonetheless. And what happens during that pause, how individuals and institutions position themselves during this window, will determine who benefits when the next chapter of this story unfolds. That next chapter is not about data anymore. It is about decisions. Strategic decisions that every businessman, every entrepreneur, every wealth builder must now confront. And that is exactly what Part 4 addresses. Knowledge without action is just entertainment. And this channel was never built to entertain. It was built to equip. Because at the end of every market event, every crash, every correction, every moment of volatility that shakes the confidence of the average investor, there is a fundamental question that separates the people who merely watch from the people who actually build wealth. That question is not, what happened? We already answered that. The question is not, why did it happen? We answered that too. The real question, the one that actually matters, is, what do I do now? And that is exactly what this final section is designed to address. Not with predictions, not with hot takes, but with a framework. A clear, structured, strategic framework that every serious businessman and entrepreneur can apply to their own situation, regardless of how much capital they hold or how deep their market knowledge runs. The first strategic reality that must be acknowledged is this: volatility is not the enemy of wealth. Ignorance is. Silver did not crash because the world ended. It crashed because the market moved in a way that millions of people were not prepared to handle. And being unprepared is not a sin. It is simply a gap in understanding, a gap in strategy, a gap in the way wealth is structured and protected. And gaps can be closed, but only if you are willing to look at them honestly. The businessmen and entrepreneurs who will come out of this event stronger are not the ones who avoided precious metals entirely. They are the ones who understood exactly why silver behaved the way it did and positioned themselves accordingly. Because this crash was not a threat to informed participants, it was an opportunity. And the distinction between a threat and an opportunity in any market event comes down to one thing and one thing only: preparation. Preparation in this context does not mean predicting the future. Nobody can do that consistently. Preparation means building a financial structure around your business and your personal wealth that does not collapse when markets move violently. And that structure begins with diversification, but not the kind of diversification most people think about. Not simply spreading money across different stocks or funds. True strategic diversification means understanding how each asset class behaves during specific economic conditions. It means knowing that when equity markets fall, certain commodities may rise. It means understanding that when the dollar strengthens, precious metals face pressure, and when the dollar weakens, they recover. It means being able to look at a market event like this one and immediately understand which of your holdings are exposed, which are protected, and which might actually benefit from the chaos unfolding around you. For entrepreneurs specifically, this crash carries a warning that extends beyond personal investment portfolios. If your business operates in any industry that touches commodities, manufacturing, international trade, or even simple cash flow management, currency and commodity movements are not background noise. They are variables that directly impact your margins, your costs, and your competitive positioning. A business owner who ignores the relationship between precious metals and the broader economy is not being cautious. They are being blind. And blindness in business does not protect you. It simply delays the moment when the market forces you to pay attention, usually at the worst possible time. The second strategic framework worth examining involves the concept of asymmetric positioning. This is not a complex idea, but it is a powerful one. Asymmetric positioning simply means structuring your exposure so that when you are right, the reward is significantly larger than the loss you would absorb if you are wrong. In the context of this silver crash, asymmetric positioning looks like this. If the historical data suggests that silver recoveries following sharp corrections tend to be significant, then a small measured allocation towards silver at current depressed levels creates a position where the potential upside is substantially greater than the downside risk. Not because silver is guaranteed to recover immediately, it is not. But because the mathematical relationship between current prices and historical recovery patterns tilts the probability in a favorable direction. This is not gambling. This is calculated risk management. And it is the same methodology that the most successful institutional investors have used for decades to build and protect wealth across market cycles. But here is where the conversation becomes genuinely important for young entrepreneurs and aspiring businessmen who are still in the early stages of building their financial foundation. The greatest mistake you can make in a moment like this is to do nothing out of fear. Fear is a natural response to watching markets fall. But fear-driven inaction is the most expensive decision you will ever make. Because while you are standing still, waiting for certainty that will never come, the market is continuing to move. Prices are adjusting, opportunities are appearing and disappearing, and the window that exists right now, the specific window where silver sits at levels that history suggests are unsustainable, will not remain open indefinitely. It never does. The third and final strategic consideration is the one that most people overlook entirely. It is called the cost of waiting. And it is invisible. You cannot see it on a chart. You cannot measure it in real time. But over months and years, the cost of waiting, of sitting on the sidelines while assets recover and revalue, compounds into something enormous. Every week that passes, while silver rebuilds from these levels, is a week of potential value that a waiting investor does not capture. And when you multiply that missed opportunity across multiple market cycles, across multiple years of wealth building, the numbers become staggering. The businessmen who understand this do not wait for perfect conditions. They know that perfect conditions do not exist. They act within imperfect conditions, with measured risk, with clear strategy, and with a long-term vision that extends far beyond the next headline or the next price movement. So where does this leave us? Silver crashed. The mechanics behind it were not mysterious. The historical data suggests recovery is likely but not immediate. The timeline depends on broader economic conditions that are still unfolding. And the strategic response is not panic, not paralysis, but informed, disciplined, calculated action based on a clear understanding of risk and reward. This market event is not a warning to step away from wealth building. It is a warning to step up, to educate yourself, to build systems and frameworks that do not depend on markets behaving the way you want them to behave, because they never will, not consistently, not reliably. The only constant in any market, in any economy, in any era of wealth creation is change. And the people who thrive are not the ones who fear change. They are the ones who are already prepared for it when it arrives. Silver Radar will continue to monitor this situation as it develops. The data will shift, new information will emerge. And when it does, this channel will be the first to break it down, not with emotion, not with hype, but with the same analytical clarity that brought you here today. Until then, stay informed, stay disciplined, and stay ahead.